So I'm still bullish on when the ETFs were came out. There was kind of like a local bubble, and Bitcoin kind of ended up chopping sideways for the next 7 months because of it, as things had to kind of work itself out. And then with the election and the rapid change in perception around what the regulation environment would be, that also gave us another really big pop in Bitcoin, which took another kind of 7 months or so to absorb before we went on to new highs again. So while things can get ahead of themselves temporarily, I still think that the zooming out sense, they were still pretty early. Most companies don't have Bitcoin on their balance sheet, and I think even in the next 5 years that'll still be the case. It'll still be a niche thing. Most governments still don't have it on their balance sheet. A handful do in sovereign wealth funds and things like that.
Lyn Alden, founder of Lyn Alden Investment Strategy, says that despite short-term hype cycles, like the launch of ETFs or political shifts that briefly pushed prices higher, Bitcoin is still in the early stages of adoption. Each of those bursts of excitement created what she calls mini bubbles, periods that took months to consolidate before Bitcoin could move higher again. And when we zoom out, the bigger picture is clear. Most companies still don't hold Bitcoin on their balance sheets, and only a handful of governments or pension funds have any meaningful exposure. When it comes to other assets, Lynn notes that gold overheated earlier this year, but instead of a sharp correction, it's been consolidating sideways, very similar to how Bitcoin has behaved in past cycles. In her view, the long-term outlook for gold remains bullish, though it's still digesting some of those recent gains. Lynn also points out that corporations are now playing a key role in driving digital asset markets. On the selling side, much of the pressure has come from long-term Bitcoin holders, people who bought years ago at much lower prices. For many of them, $100,000 per coin became a psychological milestone. Some originally bought at just $1,000 or $10,000, and when Bitcoin crossed into six-figure territory, it triggered selling, either to rebalance portfolios or to cash out. That's created a wave of distribution. Meanwhile, corporate treasuries have stepped in as buyers, marking a new phase in the evolution of digital assets. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
So in the digital asset space, I think basically right now corporations are the bulk of what's driving it. So if you look at kind of where sales have come from, it's generally come from those who've held for a while and are up pretty significantly on their gains, and then they sell to rebalance or to increase their consumption level in some way. Basically, for a lot of people, 100,000 Bitcoin was kind of their magic number. Some of them have been holding since 1,000 a coin or even less. Some people have holding since 10,000, but when you kind of hit that psychologically important number, you get this ongoing kind of distributive effect. On the other hand, there's, Strategy has been purchasing, Metaplan has been purchasing, and then we've seen this kind of breakout in other like altcoin treasury companies. I think like kind of prior cycles, it probably won't end well. A lot of companies filled up with kind of tertiary altcoins.
Yeah.
Is probably not something we look back on years from now and say, yeah, that was a good thing to do. But so I think that's kind of where that rotation's happening away from kind of older whales and more toward these kind of corporate treasuries until they get satiated for this particular cycle. I still think it's pretty early stages. I think that things can get ahead of themselves for periods of time. So, for example, when the ETFs were came out, there was kind of like a local bubble, and Bitcoin kind of ended up chopping sideways for the next 7 months because of it, as things had to kind of work itself out. And then with the election and the rapid change in perception around what the regulation environment would be, that also gave us another really big pop in Bitcoin, which took another kind of 7 months or so to absorb before we went on to new highs again. So while things can get ahead of themselves temporarily, I still think that the zooming out sense, they were still pretty early. Most companies don't have Bitcoin on their balance sheet, and I think even in the next 5 years that'll still be the case. It'll still be a niche thing. Most governments still don't have it on their balance sheet. A handful do in sovereign wealth funds and things like that. And most pensions, they might have a little slice here or there.
Yeah.
But I still think that in the grand scheme of how much capital's out there, Bitcoin as a $2 trillion asset is still pretty small in the grand scheme of things. Even though it's this global money that's still smaller than some individual equities are in terms of market cap. And so I still think it's pretty early in the kind of the integration of the digital asset space and then broader traditional markets. So I'm still bullish on Bitcoin. Gold, I started warning about this spring because it got kind of heated. Fortunately, that's been more of a sideways consolidation than a correction. And I think it's kind of you know burning off some of that heat, kind of like Bitcoin had to do a couple times this cycle. So I'm still long-term bullish on it, but it's still kind of working through that. I'm increasingly a little cautious on U.S. equities. At these levels, given the ongoing headwinds that are still there, including tariffs and things like that. I also think that rate cuts, while helpful, are probably not going to be as stimulative as people think, because without a kind of lower low in rates, especially longer term rates, I think any sort of like home refinancing cycle is going to be pretty muted this time compared to prior cycles. And so while it helps certain entities and individuals around the margins, I don't think that we'll have any sort of big gains from that rate cutting cycle. Where I tend to be more bullish is foreign equities. I still think they're very under-owned. In many cases, it's still fairly inexpensive, and the on upcoming dovish cycle should be somewhat beneficial to them. So I tend to think there's a lot of kind of you know kind of returns to be had over the next 3 to 5 years from more of that foreign sector.
Lyn Alden says the Fed's latest move was slightly more dovish than markets expected, and traders immediately priced that in. While there was no firm promise about 2026, the Fed strongly hinted we could see one or two rate cuts in the near future. But here's the challenge. It all comes back to fiscal dominance. Normally, the Fed influences inflation by adjusting bank lending. Historically, when inflation ran hot, like in the 1970s, it was tied to massive loan growth. Baby boomers were buying homes, banks were issuing loans, and that rapid credit expansion fueled money supply growth and inflation. Today things look very different. Bank lending isn't excessive. In fact, it's fairly muted by historical standards. Instead, what's fueling inflation now is government spending. First it was the big COVID stimulus packages, and now it's ongoing fiscal deficits that keep the economy running hot. That leaves the Fed in a tough spot. If they cut rates, it looks overly dovish, especially with stocks, gold, and Bitcoin near record highs and unemployment still very low. On the other hand, the housing market is frozen, and bank lending isn't really the problem. Lyn Alden's conclusion: this is fiscal dominance. The real driver of inflation and growth isn't the Fed's monetary policy anymore, it's government spending. Let's get back to the interview.
Kind of the whole point of fiscal dominance is it tends to last for quite a while. And so basically what that means is that, unlike the past 40 plus years, where monetary dominance was in play, basically bank lending decisions and by extension, the central bank, tailoring its policy to either encourage more lending or pull back lending, that was monetary dominance. Now we're in more of a fiscal dominance environment, meaning that the size and the direction of the deficits are generally speaking a larger variable than the central bank and even kind of the broader banking system. Um, Really, the only thing that's changed since then is obviously tariffs have heated up, recently, and so that's a slight break on the fiscal deficits because you're bringing in more revenue so far, mostly from the American public. And so that kind of offsets the deficits, but that's still fairly small in the grand scheme of things. We are still running above baseline deficits as a percentage of GDP. In addition, we have more information from the Fed, which is that it looks like they're going to be a little bit more dovish going forward. So while variables have changed, we're still largely in play in terms of fiscal dominance. On one hand, it tends to run hotter, which is to say that when you're running a larger deficit, all else being equal, that's somewhat of a stimulus, with the cost often being basically debasement or inflation, at least above target what it otherwise would be. Um, and it also tends to be less cyclical because a lot of those deficits are not really tied to the business cycle per se. If anything, they increase during a recession. And so while it's still possible to have recessions and you still do have cycles, they tend to be somewhat muted. It's kind of like how if you look at equities, there are obviously certain equity sectors that are a lot more cyclical than others.
Yeah.
Whereas, some like defense or healthcare just tend to be on their own cycles compared to these more business cycle ones. And what happens in fiscal dominance is kind of the broader economy tends to look more like those types of industries to some extent because the deficits are kind of always on. Compared to the more cyclical nature of bank lending. One way to kind of put it is that over the past 70 plus years, for the majority of the time, net new annual bank loans, and you can even add corporate bonds. So net bank loans plus net new bonds issued. That was a
Yeah.
larger sum than public deficits. Whereas only kind of in brief recessions do you see that the public deficit would be greater than that kind of private sector lending. Whereas now we generally see, even outside of recessions in recent years, the public deficit is larger than the sum of all new bank loans and corporate bond issuance in a typical year. And so that just, it's not to say that there's other things that aren't relevant, but they're a
Yeah.
smaller share of the pie than they used to be. It's more so a US phenomenon than a global phenomenon, but on a country by country basis, it's certainly relevant. I think, there's a cycle that countries tend to go through. The US currently is running larger deficits as a share of GDP than most European nations. It's part of the structure of the euro itself that makes that a little bit more difficult to run larger sustained deficits. But they all have kind of similar dynamics, which is older demographics. They fuel some of the deficit spending because you have that more top-heavy entitlement system. So whether it's China, whether it's Europe, whether it's the US, they all kind of are in that boat together.
Yeah.
And it just so happens that because US healthcare is very expensive, and the way we've kind of structured our entitlement spending, as well as generally speaking, a bigger share on defense as well, we're running hotter than the rest of those. But things matter around the margin. So the fact that Europe's running hotter than is normal for Europe is still relevant from an investing standpoint. It's just in absolute sense, the US is really kind of fiscally the most dominant. Yeah, I think he took a slightly dovish take compared to what the market expected. And the market kind of pretty much priced that in as soon as he was speaking about it. And basically what we should expect is generally at least slightly lower interest rates. He made no commitment to the idea that he's going to keep doing it in his 2026, but he did heavily imply that we're at least getting one or two cuts perhaps upcoming. One of the challenges, this goes back to fiscal dominance, is their interest rate tool is mostly around trying to get banks to either lend more or lend less. Because, historically speaking, during periods where inflation's hotter, there tends to be a lot of money creation from bank lending. So, for example, in the 70s, when the baby boomers were entering their home buying years, that was kind of the peak period of US loan formation. There's a lot of loans being done and greater than average money supply growth and the inflation that came with it. Obviously, there were other factors like the oil shortages and things like that, where that money supply growth actually does translate into much higher prices because you don't necessarily have that productivity offset. But basically, that bank lending is a really big component of it, and so most of the tools are around that. The problem is that in this whole kind of COVID and post-COVID environment, because we're in fiscal dominance, the inflation we've seen has not been from excess bank lending. Bank lending rates are pretty muted, if anything. They're kind of historically normal and on the lower side. And so the Fed trying to keep rates high to slow down bank lending is kind of working around the problem. The actual core of what fueled all this was the deficits. Back in years ago, it was the stimulus, and now it's a less extreme but more sustained, just ongoing, fiscal spending, which tends to run things hot. And so the Fed kind of finds himself in a position where there's no right answer. If they cut rates, it doesn't look great because they're cutting rates into like all-time high stocks, gold, Bitcoin, low employment. It looks, it kind of looks dovish on that surface. On the other hand, the housing market is pretty much at a standstill. I think even with some cuts, it's not really going to change that.
Yeah.
And bank lending is not the issue. So I can certainly see why they'd make a case for cutting. And it's just fiscal dominance. It's more about the fiscal entity than what the central bank's going to do.
As we step back and look at the bigger picture, one thing is clear. Markets are moving through a unique phase where traditional tools don't always explain the outcomes we see. Between digital assets maturing, gold consolidating, and central banks navigating around massive fiscal spending, the next few years could look very different from past cycles. The real challenge for investors will be figuring out where lasting value lies and how to position before the next major shift unfolds. Is it monetary policy or government spending that truly sets the direction of markets today? And how should investors prepare for what comes next? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support and I hope you enjoy the video.